this video, we're diving into the classic debate of gold versus stocks and which is the safer bet for you. What's going on, everyone? My name's Eric Hunsaker, and on this channel we cut through the fluff to help you make smarter decisions about your investments. With economic uncertainty, market volatility, and talk of recessions or rallies, many investors wonder if they should take refuge in gold or stick with the stock market. Today we'll unpack the pros and cons of each, talk about a little bit of their historical performance, and just offer guidance on how to balance them in a diversified portfolio. Understanding stocks. What stocks represent. When you buy a stock, you purchase a share of ownership in a company. Stocks provide a stake in the company's earnings and assets, and they can produce returns through price appreciation and dividends. Over the long term, stocks have been one of the most effective ways to build wealth. The stock market's average annual return has historically been higher than most other asset classes, including gold. That said, stocks can be volatile, and their prices are influenced by a range of factors: corporate earnings, interest rates, consumer demand, geopolitical events, and investor sentiment. Types of stocks and diversification. So there are many ways to invest in stocks. You can buy individual companies, but that exposes you to company-specific risk. Diversification helps reduce that risk. A convenient way to diversify is through mutual funds or exchange-traded funds, ETFs, that hold hundreds of stocks across different sectors and regions. Vanguard is known for its low-cost index funds, which track broad market indexes like the S&P 500. These funds offer diversified exposure to the market at a low fee, making them a popular choice for long-term investors. Active funds or managed portfolios aim to beat the market but often come with higher fees. Stocks and economic growth. Stocks tend to perform well during periods of economic growth because corporate profits rise and consumer spending increases. During recessions, stock prices can fall significantly. Investors who stay in the market for the long haul often ride out these cycles and benefit from the overall upward trend. Dividends from stable companies can also provide a steady income stream, adding to total returns. However, investing in stocks requires tolerance for short-term volatility and discipline to avoid selling during market turndowns. Understanding gold. The role of gold. So gold is a precious metal that has been used as money and a store of value for centuries. Its value doesn't stem from earnings or dividends, but from supply and demand, investor sentiment, and its role as a safe haven asset. Gold shines when investors lose confidence in other assets. It tends to do well during periods of high inflation, currency devaluation, or geopolitical turmoil. It's considered a hedge against systemic risk because it isn't tied to corporate performance or government policies in the same way stocks are. Ways to invest in gold. You can invest in gold by buying physical metal, coins or bars, through a dealer, or by purchasing financial products that track the price of gold like ETFs. You can also invest in mining companies, which are influenced by both gold prices and the success of the company's operations. Another route is a gold IRA, offered by companies like Augusta Precious Metals, which allows you to hold physical gold within a tax-advantaged retirement account. Each method has its pros and cons, including costs, liquidity, and storage requirements. Gold's historical performance. Gold's price history has been marked by long periods of stability, punctuated by sharp rises and declines. After being largely controlled by government policy until the 1970s, gold's price was allowed to float freely. It rose dramatically in the late 1970s during high inflation, then fell and stagnated for years. It surged again in the 2000s during the financial crisis, reaching a record high in 2011 before declining and then rising again. Long-term annualized returns for gold have been lower than for stocks, but higher during certain crisis periods. Gold's volatility means it can act as both a hedge and a speculative asset depending on the environment. Historical comparisons of gold and stock. Long-term returns. Since the 1970s, when private ownership of gold became legal in the United States, stocks have produced higher average annual returns than gold. The S&P 500's long-term compound annual growth rate has been around 9 to 10%, while gold's has been lower, closer to 5 to 6%. That said, these are averages. Individual years or periods may tell different stories. For instance, during the 2008 financial crisis and the early pandemic years, gold outperformed stocks for short stretches. Investors who sold stocks at the bottom and bought gold at the top may feel differently about the comparison, underscoring the importance of staying invested and diversified. Volatility comparison. Both gold and stocks can be volatile, but their patterns differ. Stock volatility is driven by corporate earnings, economic data, and news. Gold volatility is influenced by currency movements, interest rate, and investor sentiment. For example, when real interest rates minus inflation, are low or negative, gold tends to perform well because the opportunity cost of holding a non-yielding asset is reduced. When real rates rise, gold may suffer. Stocks, on the other hand, benefit from low rates because borrowing costs are lower and consumer spending often rises. Understanding these dynamics helps explain why gold and stocks can complement each other in a portfolio. Risk and return considerations. Risk tolerance and investment horizon. Deciding whether gold or stocks is safer depends on your risk tolerance and your investment horizon. If you're a long-term investor with decades until retirement, stocks offer higher potential returns and the benefit of dividends. The risk is that you must endure market turndowns without selling at the wrong time. If you have a shorter horizon or a lower risk tolerance, gold might seem appealing, but relying too heavily on gold can reduce your portfolio's growth potential and leave you short of your goals. A balanced approach usually works best. Keep the bulk of your investments in diversified stock funds and allocate a small portion, maybe 5 to 10%, to gold to hedge against crises. Emotional factors. Investing isn't just a numbers game. Emotions play a role too. Market drops can trigger fear, prompting some to sell stocks and seek safety. Gold often becomes more attractive during these periods because it feels more secure. However, emotional decisions can be costly if they lead you to sell productive assets at the bottom and chase safe haven assets at the top. Setting clear guidelines for your asset allocation and sticking to them helps manage these emotions. Understanding that volatility is normal and that markets have always recovered over time can reduce the impulse to jump to gold when stocks fall. Portfolio strategy, combining gold and stocks. Diversification benefits. The key to reducing risk without sacrificing return is diversification. Holding both gold and stocks can provide a smoother ride because they react differently to economic conditions. For example, when inflation rises and real interest rates fall, gold tends to outperform. When the economy is growing and corporate profits are rising, stocks tend to outperform. By owning both, you don't have to predict which environment will dominate. You benefit from both scenarios. This is why many advisors recommend a small allocation to gold within a stock-heavy portfolio. Rebalancing an allocation. Decide on your target allocation to gold and stocks based on your risk tolerance and goals. For instance, you might hold 90% stocks and 10% gold. Then once or twice a year, rebalance your portfolio back to this target. If stocks rally and your stock portion grows to 95%, you'd sell some stocks and buy gold to get back to 90-10. Rebalancing forces you to buy low and sell high, which is one of the keys to disciplined investing. It also ensures that neither asset class becomes too dominant in your portfolio. Choosing investment vehicles. For stocks, low-cost index funds from providers like Vanguard are a strong foundation. They provide broad market exposure, low fees, and require little maintenance. So if you want to get started with Vanguard, we've got a link for you down in the description below where you can go ahead and see their featured investing products. Just click the link down below in the description to learn more. For gold, you can choose physical gold through a gold IRA like Augusta Precious Metals, gold ETFs, or even stocks of gold mining companies. Each option has different costs and risk profiles. A gold IRA from a company like Augusta Precious Metals provides direct ownership of bullion with within a retirement account, but it comes with higher fees and complexity. Gold ETFs offer simplicity and liquidity at a lower cost. So weigh the pros and cons to decide which vehicle suits your needs. And if you're interested in hearing more about Augusta Precious Metals and their gold IRA, we've got a link for you down in the description where you can learn more. So, which is the safer bet for you, gold or stocks? The answer is that both have roles to play in a well-rounded investment strategy. Stocks offer higher long-term returns and dividends, but they're volatile and can suffer during recessions. Gold doesn't generate income, and it can also be volatile too, but it often holds value when stocks falter and inflation rises. By allocating most of your long-term investments to a diversified stock portfolio and a smaller slice to gold, you create balance. So rather than choosing one over the other, use both to build resilience, growth, and a peace of mind in your portfolio. So do your research, define your goals, and stick to a plan that fits your risk tolerance. So if you want to get started with either Augusta Precious Metals for your gold IRA or Vanguard for your stock portfolio, you'll find links for both down in the description below. Now, these are affiliate links, which means we do earn a small commission if you do decide to use them at no extra cost to you. It really helps support the channel, and it lets us keep making simple, beginner-friendly videos to help you take control of your money. So if you end up using them, we thank you so much in advance. And if this video helped you out, don't forget to like, subscribe, and tap that notification bell so you never miss a new video. Here on Your Money Friend, we talk about saving, banking, investing basics, and all the little money decisions that make life easier without the confusing jargon. So thanks for watching, and we'll see you here in the next video.